Yeah, morning traders. If we go across asset class for a US trade, it has been somewhat of a chop fest for traders to navigate on an intraday basis. I think the sort of big focus has been around core CPI. Now, if we have a look at that on a month-on-month basis, we saw that coming out at 0.31 of 1%. The consensus was 0.25 of 1%, so slightly hotter if we want to be pedantic about that. And that took us to an annualized rate of 3.9%, so a slight moderation from the prior month of 4.01%. Now, if we go into the sort of the various subcomponents of that, goods inflation came out at 0%, so slightly hotter than last month. And if we look at core services, came out at 0.44 of 1%. Obviously, we're seeing very sticky rents and OER at the moment. We saw core services ex rents coming out at 0.4 of 1% on month, and again, slight moderation from where we were last month as well. But if we take the components of that core CPI print and we project them and we extrapolate them into the core PCE number, which of course the Fed looks at more closely, and that number comes out on the 27th of January, the run rate at the moment is about 0.2 of 1% for month on core PCE. Now we're going to take components of the PPI numbers that come out in the session ahead, and then we'll get a much clearer picture. But at the moment, core PCE is running about 0.2 of 1% month basis. Now also, we saw claims coming out at 202. That was pretty good numbers there, slightly hotter than what the market was looking for. We've seen conversations from Loretta Mester, Charles Goolsby, and Thomas Barkin once again. Now look at the wash up that we've been seeing across markets. It has been quite a punchy move in rates if we want to start there. Now, if we look at near-term expectations through swaps, there hasn't really been much of a move, as you can see here. We can see that rates for March are still priced at 76% chance for a 25 basis point cut there. We can go out to the end of the year, we've got 153 basis points of cuts, so just over 6 basis points cut. So all of these factors that we've been seeing haven't really manifested any kind of repricing of rates. Where we actually can see a big move, actually, if we go into SOFR futures for further out the curve, we can see into the red contracts into early 2025, pretty material shift, about 13 basis points of additional cuts being priced in. And you can see that in the 2-year Treasury at the front end of the Treasury curve, which is down 10 basis points as I speak. I don't think anyone really understands why we've been seeing this. Now, we saw the CPI numbers don't really justify that bid that we've been seeing. We also saw a 30-year Treasury auction, which went off okay, pretty average demand. Bit meh, really, to be honest, but it doesn't really justify why we've seen such a bid and the move down in Treasury yields. And we're actually eyeing those recent lows now, 27th of December lows of 422. Be interesting to see there. But we've seen a decent bull steepening of the Treasury curve playing through. Now that has manifested and really resonated across asset classes. Have a look at the intraday chart of the Dixie, the dollar index. We traded up to 102.70 post CPI, but then there's been sellers playing through to where we are at the moment around 102.30. Aussie dollar traded down to 66.50. But we've just managed to find a bit of a bid as risk came back into the market as bond yields fell, and that's currently trading 66.84 at the moment. Gold prices were trading heavy as they have done recently. We traded down to 2013, but that moved down in yields, that moved down in the dollar on the back of what we saw there, pushing up to 25. And we've seen a pretty flat move in the oil price as well. But have a look at this intraday chart of equity markets. We traded down to 47.72 in SPOs, and the bid came back in. We've got cash markets pretty much trading around the flat 9. Now, it's a pretty poor quality rally that we saw off those lows. We've seen about 35% of stocks higher on the day as we go into the close as I speak at the moment. It's tech and energy which are working okay. On the bottom of the pile, you've got utilities and REITs taking out a few points. Now, if we have a look at banks, they are trading pretty heavy. That's an important one because in the session ahead, we are going to be seeing earnings from Bank of America, Wells Fargo, JP Morgan and Citigroup. So obviously one that could be a potential event risk for people. And if we have a look at the KRE, the regional banks, that is trading heavy, down about 1.6% as I speak. So the NASDAQ outperforming at the moment. But it's these bond yields which are just really rallied very, very sharply. And you can't really justify that from the Mester comments, from the CPI comments. But again, we're always trying to find a narrative for the price move. Sometimes it's just the flow show that plays through. In the session ahead, we are expecting Asia to open on a bit of a mixed note. We've got sort of modest downside called for the Hang Seng and the ASX 200. But once again, we're expecting to see the Nikkei outperform. That market's been on fire again. So watching PPI numbers in the session ahead, bank earnings, and we're looking for a bit of a mixed picture in Asia today.